Welcome. This is Tax Pro Nation, the home of the independent tax professionals, where you can find a tax community, maximize your earnings, and live life on your own terms. I'm your host, Imelda Ledesma, COO of Pronto Tax School. In this episode, Andrea will lead the conversation on how to handle out-of-state rental properties on a Schedule E. And you'll get to see the difference between how the real world stacks up and what social media is trying to sell your clients.
Here we go. Let me hit that. We're going to be doing some hands-on rental property scenario. We're going to be looking at a Virginia resident who has a Wyoming LLC and a rental property in North Carolina. Because if you are working with real estate investor clients, they are getting some crazy information from somewhere. TikTok, I don't know, some workshop they're all going to. And so they're all setting up Delaware LLCs or Wyoming LLCs and buying properties all over the place, and it creates all kinds of confusion. So we are actually going to be getting into the software, working through generating the rental property return and looking at some of the state tax issues. You know, where do you have to file? Where don't you have to file? So it should be a fun session. I'm pretty sure Andy's going to be joining us, so we're going to wait just another couple minutes while he comes in to get settled. While we wait, does anyone have anything they want to make sure gets addressed today? Any question you want to make sure that we make time for? I do expect that today's topic is probably going to take pretty much the whole time. So if you have something unrelated to today's topic, now might be a good time to chat about that. Also, I want to give everyone a heads up. I already mentioned that I've been having some internet connectivity issues this morning. A couple of meetings that I've been on already, I kept getting kicked out. So hopefully that doesn't happen on ours, but I make no promises. Let me get my software set up. Another little caveat is that we're going to be working in Drake Tax today. And for me to access Drake, I actually have to remote into a computer at my office. So it's not exactly the fastest experience in the world. So y'all have to bear with me as it runs a little bit slow. So I'm going to get connected here. Okay, so that is ready to go. Trying to make sure I have everything set up so we can dive right in as soon as we're ready. Let me check the chat. Sean has a client who rented parking on his personal property. How would you report it? Good question. So, for example, like for an event, right? He'd let people park in his driveway or on his grass or something. Is that the kind of deal you're talking about?
No, actually, he has a dude ranch. They've leased land, so he lets the owner park a trailer on the back of his property.
Okay, so it's a long-term kind of deal, not just like a one-time.
Yep.
Good question. Normally,
the previous account was depreciating the entire house.
No, that's not right, because first of all, it's land and land isn't depreciable. So there is no depreciable asset to offset the rental income. The question, I guess, really is, where does it get reported? Is it Schedule E or Schedule C? Or is it just other income not subject to self-employment tax? So short answer, go ahead.
I said, I would say it was Schedule E because it's a rental. Just because it's a rental doesn't mean it's depreciable. So, and you're renting space that you own. So therefore it would be, that's where I would put it.
I would have to do some research on that, because I think you could make the argument that it's just Schedule 1 other income.
So, it would have the same effect on the tax returns, 6 of one, half dozen of the other.
It would, but I mean, we should still be reporting it in the correct place. Because it could also be Schedule C, not subject to self-employment tax. So there are a few different places that you can report income items that won't generate self-employment tax. So that's a good question. Short answer is I'm not exactly sure where that would be reported. If it was like a one-off thing, I'm renting space on my land for an event, like I live close to a fairground, that would definitely for me lean towards Schedule 1, but
Well, I would
since
call
it's,
that under the Augusta rule and not reported at all.
well, it depends how many days, right? If you live next to fairgrounds that have festivals throughout the year, it could end up being more than 14 days.
Yeah. This is an ongoing, it's been going on for years. The previous person was depreciating the entire house.
Yeah, I know that part's not right because the person, like, they're not parking the vehicle in all the rooms of the house, right?
Yeah.
I'll have to get back to you on that, but that's a good question. Does anyone have any input? Client rented parking on his personal property. So he's basically, it's almost like it's like a parking lot. So if you had a client who owned a parking lot, where would that get reported?
But if about a parking lot, that would be a business.
Well, what's the difference?
I mean, if I'm actively running a parking lot, that's an active business.
Not necessarily. It's concrete that people drive into and out of, but you don't have to be there.
No, but then you have employees that have to be there.
Not necessarily. If you have like monthly passes and an electronic gate, right? Or like a
Well, then now you're
parking
operating.
meter.
You're going into,
So in that case, like in the example of a parking lot where people buy monthly passes, how is that any different than this person parking on your client's land? He has to invoice the person and collect money.
I'm not 100% sure, which is why I did the question.
I know, yeah. I'm just talking through all the,
Yeah,
I'm talking
I know
through-
depreciating the entire property is not the right answer.
yeah, that's definitely wrong. We can all agree on that, I think. Tosin says Schedule E probably, and that is also what Linda said. I mean, there's probably no harm in reporting it on Schedule E. You just wouldn't have a depreciable asset attached to it.
On the
But
primary, when he sells his house, since I didn't depreciate anything, I wouldn't report it as sale of a business asset.
correct.
Because he came to me, they didn't file the 22, because the other person had been depreciating the house for years. And so when he sold the property, he reported 30% of it as loss of capital gains on the sale of the property. Well, the whole thing's been reported wrong, so I was going to do a 3115 and do change of accounting, basically reclaim all the depreciation. Well, basically add all the previous depreciation back as claimed income. And then not,
Yeah, I mean, the most technically correct approach would be to do the 3115 to remove the depreciation deduction that they've, obviously your client's not going to be super happy about, but I think that's the move.
well, actually, he's happy because it put $120,000 in capital gains, took it off his tax return. Because now he can claim it as sale of primary residence and not claim the capital gains. So it actually reduces his tax bill by over $10,000.
Okay, well, that's good. He'll just have to report the depreciation that he has taken will be ordinary income in this year.
Right.
Okay, well, good then. Good outcome. Okay, I thought Andy was joining us. He may not be, so we're going to go ahead and get started because this is not a super involved scenario, but definitely one worth working through. So let me get logged back into my tax software and then I will share my screen. We'll go over the scenario again. Also, let me zoom this in because y'all are not going to be able to see this. Hold, please. I should have had this ready, y'all. Sorry. So the scenario that we're going to be talking about today is a rental property because, we're in a series with Pronto for rental properties. We're going to be talking about a person, an individual taxpayer, and in the sample return, I've just made them single because it's easy that way. So an individual taxpayer who is in Virginia, so they're a Virginia resident. They formed a Wyoming LLC to hold a North Carolina rental property. And so we're going to talk through what that return will look like. We're going to talk through what states get what reported where. And okay, so that is the foundation for today's chat. Let me get the return open before I share my screen because we don't want to see all the things in my software, just this thing. Give me 1 second. Have any of you had any clients with that type of scenario where they're forming LLCs because like they heard on some social media, maybe say TikTok, that they needed to form in Delaware or some other crazy convoluted setup.
The Anderson Consulting Group is awful.
I guess I don't know. It's interesting because typically if you're operating in a state where your LLC is not registered, you have to register as a foreign entity. So like you really haven't saved yourself anything. I keep wondering, like, am I missing something? But there's no benefit that I can think of. Okay, I'm going to attempt to share my screen. Remember what I said about I'm going to do this in Drake, which to access Drake, I actually have to remote into a computer at my office. And so the experience is a little bit not super fast. Let me share my screen. Okay. So you all should be seeing my Drake tax screen here. Let me get this set up and let me get my scenario pulled up. Andy prepared a lovely list of questions for us to go over. So we've already set the stage. Can everyone see this? I feel like this is kind of small. We have sample taxpayer who lives in Richmond, Virginia. So they are Virginia residents. Again, they formed a Wyoming LLC to hold a rental property that is located in North Carolina. So we all know single member LLC is a disregarded entity for federal tax purposes. So when I'm entering into the tax return, I don't really have to worry too much about the states other than that when I set it up, I am going to identify the Schedule E as being in North Carolina. And your software obviously will look a little bit different, but in Drake, entering the rental property information is fairly simple. We need to enter the fair rental days. In this example, I'm using 365. Let me stop sharing for a second and see if I can get this bigger because I can see a couple of you straining to see, and quite frankly, I am as well. I'm so used to being at my desk with my big, huge monitor that this is not doing what I want it to do. Sorry, y'all. I had this all tested and set up and it's like all the settings reverted. Anyway, we're gonna carry on. Okay, so entering the rental property information is probably similar in most softwares, right? In Drake, there are a couple of different ways you can enter rental income. If you get a 1099 miscellaneous, you can enter it in the 1099 miscellaneous screen and then link it to the right Schedule E, or you can go right to the Schedule E screen and enter that. So we've got our income, we've got our expenses. $5,000 seems kind of high for advertising to me, but we're going to go with it. If this were my actual client and that was information they gave me, I might dig into that a little bit. $5,000 sounds a little bit high for a property that's only generating a little under $14,000 in rental property income. We have our mortgage interest, we have utilities, and when we view the Schedule E in the return, we'll see depreciation. So in Drake, there is a depreciable asset section, and I'm sure whatever software you use has a similar scenario. So we enter the rental property. We need to remember that in this case, at least in Drake, how Drake is set up for entry, the cost is the building value, not the building plus land. We allocate the land lower. So this cost, this is the field that depreciation is calculated on. So you need to enter the building value only. It's section 1250 property. In Drake, the method, they call it ARR, that's makers, but it's straight line over 27.5 years for residential rentals. Useful life is 27.5, and then we've got the land allocated. Now, in Drake, next year, when we do this second year return for this client, this is a new client to us, let's say, then it will populate prior depreciation. But right now, we're going to say that, let me put this the correct year here. In service 1/1/23. This is the first year. Any questions about entering the rental property return in the rental property in the asset detail screen in Drake? I think we probably all are pretty clear on that. The most important thing is to understand how your software, like what field it looks at to calculate depreciation. If your software is like Drake and it looks at this cost field, you have to make sure to exclude the land value in that field. Okay. This is all pretty basic stuff. We're just kind of setting the stage here. So then what does that look like when it comes time to file the tax return? One of the questions that Andy wanted me to go over, and we'll talk about this as we set the stage for the different types of returns, is how much should you charge for a return like this? It seems simple enough on its outset, right? Single taxpayer. I've entered that they have one W-2 job just to give the tax return a little meat. And so what are the state filing requirements? How complicated is this going to be to report? What should we charge for this type of return? So we're going to go over that towards the end because I want you guys to weigh in on that. The next question is, and I'm going to pose this to you before I dig into the meat of it. Virginia resident, North Carolina rental property. So they have presumably some income or maybe a net loss in North Carolina, and a Wyoming LLC. What state tax returns do y'all think will need to be filed? It's going to be one of those days, huh, guys?
North Carolina, Virginia.
Okay, I agree. So one of the questions is, how as tax professionals do we even know? How do we figure out where a return needs to be filed? And when I was preparing for today's session, as I was building this return and as I was working through the list of questions that Andy provided, I actually went through the process I would go through if this was a new client to me. I went on the Wyoming. I use Google as the starting point for all of my research. So I Googled whether Wyoming has an LLC filing requirement. A lot of you are in California. California has an LLC filing requirement that is separate from the federal return, right? Some states do, some states don't. I don't know about y'all, but I can't remember which states do and which states don't. So I started by Googling, does Wyoming have an LLC filing requirement? What I learned in that search is that while LLCs do not have a specific tax return in Wyoming, Wyoming does require LLCs to file an annual report. And there is a fee associated with that. I think it's $60. So I know already that most likely this client is going to have to file a Wyoming annual report. So minimally, they have that filing and that $60 fee. Wyoming also assesses a license tax that is either a flat fee or a percent of the value of the assets that are located in Wyoming. So in our case, for our client, there are no assets in Wyoming. The asset is in North Carolina. So they may not have a license tax requirement in Wyoming. Now, what about Virginia? They are a Virginia resident. Their business is registered in Wyoming and their business asset is in North Carolina. Do you think that the client will have to register as a foreign entity in Virginia?
Virginia does not have an initial requirement.
Correct. I think, right? Like this is all research I'm doing, just like I would for any other taxpayer in Virginia. So if the rental property was located in Virginia, then I would say, yes, probably they have to register as a foreign entity in Virginia. However, they're not actually operating any business in Virginia. There's no business asset. There's no LLC registered. So there is no requirement in Virginia to register as a foreign entity. Now, what about North Carolina? Go with yes, right? So I went back to Google because again, even though North Carolina is a neighboring state, I haven't encountered every potential scenario. So I went back to Google as my initial research point and asked if a business that is registered in a different state but has assets in operation in North Carolina is required to register as a foreign entity. And my research indicated yes. So in my opinion, I'm not an attorney. I don't know for sure. Research, the client is going to have to register as a foreign entity in North Carolina. And then North Carolina does have an annual report filing requirement. North Carolina does not have a separate LLC tax return. So Virginia and North Carolina are similar in that way. No separate LLC tax return, but there is an annual statement filing requirement. So they are going to have to renew their LLC every year in North Carolina as a foreign entity. So now they have a filing requirement, an annual report requirement in Wyoming, and an annual report requirement in North Carolina. No business tax returns in either state. Now, what about when it comes time to file the income tax returns? We know we're reporting it on the federal return. Let me make sure my computer just went to sleep. I'm going to stop sharing for a second. We know we have a federal filing requirement. What about, so on the personal tax return, How many of you have had to file a tax return in Virginia or for a Virginia resident before? Probably at least a couple of you.
I have.
So Virginia, like a lot of states, requires you to report all income earned, whether it was earned in Virginia or not. Okay, so for this particular client, as a starting point, we're going to be reporting everything on their Virginia return. Virginia and North Carolina have an agreement, reciprocity. And so on Virginia return, you get a credit for the tax you pay in North Carolina and vice versa. So North Carolina is going to be a non-resident filing. If there was tax assessed, if there was enough net income on the rental property to result in a tax liability, the tax that's paid in North Carolina is going to become a credit. It's called credit for taxes paid to another state, other state credit, on the Virginia return to reduce the Virginia liability by the amount of the tax that you paid to North Carolina. But it's still reportable on both. Pronto, Imelda said, most people won't want to do that because they're so confused why they have to do that since they registered to Wyoming. Some people even get upset, referring to the foreign entity in North Carolina. You are right, Because when they get this advice on social media, they don't hear the rest of the story. They hear register in Delaware for anonymity or register in Wyoming because there's no state tax and so your income won't be taxable. That's like one piece. It's clickbait. It gets a lot of views and it gets shared a lot, but they don't tell you the rest of the story. And then we end up being the ones having to deliver the bad news. It's a whole lot of fun. So
Thank you for joining us. I'm Imelda. Join us next week as we continue to share mini audio clips of Schedule E tax prep process. If you are interested in listening to the full process and want to be part of our Dream Team community, please visit prontotaxschool.com or email us to support@prontotaxschool.com. Being part of the Dream Team membership comes with getting expert support, top-rated training programs, and weekly video live events. We look forward to having you on board.